customer buys a vehicle from one of the world's largest automotive manufacturers. But what happens to that money after the payment is made? Most people see the final product. They see the vehicle leaving the showroom. But behind that single purchase is a massive financial system. That money must travel through suppliers, factories, employees, research, technology, taxes, financing decisions, and future investments. The important question is not only how much money a company receives. The important question is, where does the money go? Today, we are breaking down the cash flow system of Toyota as an example of how a global manufacturing company manages money. This is an educational analysis designed to explain business finance concepts. It is not investment advice, and it does not represent any company recommendation. To understand how companies really work, you need to understand one important difference. Profit is not the same as cash. A company can report a profit and still face cash challenges. Why? Because accounting records and real money movement do not always happen at the same time. Imagine a manufacturer completes a large order and records the sale. On paper, revenue increases. But what happens if the customer payment arrives months later? The company still needs cash today to pay workers, suppliers, transportation costs, and factory expenses. The income statement may show business activity, but the cash flow statement shows the movement of actual money. Think of the cash flow statement as a map. It shows where cash comes from, where it goes, and what decisions management makes with that money. Every cash flow statement has three major sections: operating activities, investing activities, financing activities. These three sections tell the story of how a business operates. The first section is operating cash flow. This represents cash generated from the company's main activities. For an automotive manufacturer, this includes money collected from customers, payments received through business operations, and the cash required to support everyday activities. A vehicle manufacturer has a complex operating system. Before a vehicle reaches a customer, thousands of financial movements have already happened. Raw materials must be purchased. Parts must be produced. Suppliers must be paid. Workers must be compensated. Factories must continue operating. The question operating cash flow answers is simple. Is a company's core business producing real cash? A company can survive temporarily through borrowing or selling assets. But a strong operating business usually needs its everyday activities to generate cash. The second section is investing cash flow. This shows how a company uses money to build the future. For a manufacturing company, investing often means spending money on long-term assets. This can include production equipment, factories, technology systems, research facilities, and other resources needed for future operations. Investment spending is not automatically a negative sign. A company may spend significant amounts of money today because it is building capacity for tomorrow. The key question is the company investing efficiently? The third section is financing cash flow. This shows how a company manages relationships with lenders and owners. It includes borrowing money, repaying debt, paying dividends, and other decisions involving capital. A company may raise money to expand. Later, it may return money to shareholders or reduce its obligations. Together, these three sections create a complete picture. Operating activities show the engine of the business. Investing activities show how the company prepares for the future. Financing activities show how the company manages money with investors and lenders. Now let's look deeper at how the cash flow statement is created. The process usually begins with net income. But net income includes accounting adjustments that do not always represent immediate cash movement. One example is depreciation. Depreciation is the gradual accounting cost of using a long-term asset over time. For example, a factory machine may be purchased today, but accounting rules spread that cost across several years. The cash left the company when the machine was purchased. However, the expense appears gradually over time. Because of this, cash flow statements adjust for certain non-cash items. In simple terms, the company starts with the accounting result and then removes the effects of items that did not involve actual cash movement. This is why cash flow analysis is so important. It moves beyond what appears on paper and focuses on the real movement of money. For a manufacturing company, this becomes even more important because physical production requires constant movement of cash. Materials must arrive. Factories must operate. Inventory must be managed. Customers must pay. Every decision affects the financial system. In the next part, we will follow the money deeper into Toyota's operating cash flow, working capital, factory investments, financing decisions, and the free cash flow number that shows how much financial flexibility remains after running the business. If you want to understand how the world's largest companies actually manage money, make sure to like the video, subscribe for more finance breakdowns, and comment below. Which part of cash flow do you think is hardest to understand? Operating, investing, or financing? Now let's continue following the journey of money through a global automotive manufacturer. We have already explored the three major sections of the cash flow statement: operating activities, investing activities, financing activities. But the real understanding comes from looking inside these sections and seeing how individual decisions affect cash. The first area is operating cash flow. This is where the daily business activity becomes real money. For a manufacturing company, one of the most important concepts is working capital. Working capital represents the short-term resources a company uses to operate every day. It includes areas such as receivables, inventory, and payables. Receivables are payments customers still owe the company. Here is the simple rule: when receivables increase, cash can decrease. Why? Because the company may have recorded a sale, but the payment has not arrived yet. The business has generated revenue, but the cash is still outside the company. Inventory creates another important cash flow decision. A vehicle manufacturer must carefully manage thousands of parts and finished products. If too much inventory builds up, cash becomes tied inside vehicles and materials that have not yet generated revenue. The company has spent money, but that money has not returned through customer purchases. However, when inventory moves efficiently, cash can return faster into the business. Payables work differently. Payables represent money owed to suppliers. When payables increase, a company may temporarily keep more cash because it has received materials or services but has not paid suppliers yet. This timing difference is one reason why two companies with the same profit can have completely different cash situations. Cash flow is not only about how much money enters. It is also about when money moves. For automotive manufacturers, the relationship between suppliers and production schedules is extremely important. A small change in inventory levels or payment timing can affect billions in cash movement. Now let's move to investing activities. This is where companies decide how much money to put into future growth. Manufacturing businesses require significant investment because physical production requires physical assets. Factories, equipment, technology systems, and research facilities all require capital. This spending is known as capital expenditure, or CAPEX. CAPEX is simply money spent on long-term assets that help a company operate. A factory machine is not just an expense. It is a tool designed to produce value for many years. However, companies must balance investment carefully. Too little investment can limit future growth. Too much investment can reduce available cash. One useful comparison is looking at capital spending alongside depreciation. Depreciation shows how much value existing assets lose over time through use. Capital expenditure shows how much money is being invested into new or improved assets. The relationship between these two numbers can provide insight into how a company is maintaining its operations. But context matters. A growing manufacturer may naturally invest heavily. A mature manufacturer may have different priorities. The numbers alone do not tell the entire story. Now we reach financing activities. This section explains how a company manages its relationships with investors and lenders. Companies can raise money by borrowing. They can repay debt. They can distribute money to shareholders through dividends. They can also make decisions about their ownership structure. The key question is the company generating enough cash from operations to support these decisions? A A financially healthy company usually has a balance between investing for the future and maintaining financial flexibility. This leads us to one of the most discussed concepts in corporate finance: free cash flow. The basic idea is simple. Free cash flow is the cash generated from operations after subtracting capital investments needed to maintain and grow the business. It represents the money available after the company has funded its core operations and important investments. This remaining cash can provide flexibility. A company may use it for expansion, reducing debt, returning money to shareholders, or preparing for future challenges. However, there is an important detail. Free cash flow does not have one single universal definition. Different companies and analysts may calculate it differently. That means anyone analyzing free cash flow should understand exactly what is included and what is excluded. Now let's look at 4 simple questions anyone can ask when reviewing a company's cash flow. First, is operating cash flow positive? A company's main business should eventually generate real cash. Second, does cash generation support reported profit over several years? Strong businesses usually show a connection between earnings and cash generation. Third, is the company investing enough to maintain and improve its operations? A manufacturer must continue investing in equipment, technology, and production capacity. Fourth, are shareholder returns supported by cash generation? Or does the company need additional borrowing to fund those decisions? These questions do not predict the future. They simply help people understand how a business machine operates. Now return to the original question. Where does $1 go after a customer makes a purchase? That dollar does not simply become profit. It travels through a complex system. A portion supports suppliers. A portion supports employees. A portion maintains factories and equipment. A portion funds future investments. A portion may return to investors. And the remaining amount represents the financial flexibility created by the business. This is the true purpose of a cash flow statement. It is not just a collection of accounting numbers. It is a record of decisions. It shows how management chooses to use the resources created by the company. And this lesson applies beyond Toyota. The same framework can be used to understand manufacturers, technology companies, retailers, energy companies, and businesses around the world. Once you understand cash flow, financial statements become easier to read. You stop seeing random numbers. You start seeing a system showing where money comes from, where it goes, and how businesses survive and grow. If this breakdown helped you understand how companies actually manage money, make sure to like the video, subscribe for more finance education, and share this with someone who wants to improve their financial knowledge. And comment below.